So good morning, class, and you are welcome to our class on risk management. Risk management. One thing we need to embrace is that in every facet of life, there is risk. So is any investment that we are doing, there is always risk. Risk is everywhere. But it is up to each and every individual to manage the risk. All right. So here we are looking at how to manage risk. We will look at the various forms of risk and how to manage those various forms of risk. All right. So this session will be grouped into first dealing with the introduction to risk management. And we will look at how to manage foreign exchange risk management. So we will look at the foreign exchange risk management. Of course, there are three types of risk that comes to the currency, and we will be looking at the internal, most importantly, the transactional risk. We will be learning how to manage that. And in terms of managing that, we will look at the internal methodology, or what we call non-derivatives. Then we will look at how we will use derivatives to also handle it, which is also called the external. All right. So now, first of all, we kick off with our introduction to try and look at what we call a treasury department, a treasury function. Treasury function. We all know positions of treasury. I mean, in those days, hardly will you hear of an accountant and bookkeeper. We deemed them as treasury. They were fund keepers, all right? They were making sure that whatever organization they are in, there is liquidity of funds. So the role of the treasury management stems up to the fact that they are making sure the financial management in an organization are well kept. All right. So the management of funds now, therefore, they are going to be managing cash. They are going to be doing liquidity management. They are going to make sure that there is all sorts of corporate finance available. So corporate financing, making sure that everything is available. But most importantly, they are going to help us manage all forms of financial risk. All right. So that is treasury. So here we are looking at cash management. You should look at the cash position or monitor the cash position of an entity. It's like doing a petty cash. So if you know that the thing is getting to a certain level, then you hint up, all right, because you need to use that to check your working capital. So they are supposed to help. So you see, in a finance department, as we call it, there has to be somebody who is an accountant recording historical issues. There has to be somebody who is pure finance based to look at all these forms of function. All right. So you see, there's somebody always in the office in charge of petty cash. It's like a treasurer. All right. So in terms of reducing sometimes demeaning the name with petty cash holders, let's call them treasuries, or let's call them the treasures. All right. So the treasures is the money. All right. So let's just call them the treasurers. Okay. So that is that. So those who are keeping the treasures. All right. So the treasury function, all right, will help kind of the entity have some form of cash all the time in short term, medium term. All right. So that is that. So apart from that, they are supposed to do corporate financing. What do we call corporate financing? Source the money, manage debt. Okay. So you need to do that. Of course, they are supposed to make sure that the company is always having liquidity, and it's kind of have a bearing on this cash management. All right. So that is that. They are supposed to check the position of the cash of the entity. and also be able to forecast. All right. So treasurers are able to forecast. Okay. So that is that. Anticipate the funds that they need in future and determine ways of meeting those cash reserves. All right. That is that. Then we have financing. Of course, we've dealt with financing. You have to find out how we can raise capital, sources of funds, and also manage the debt portfolios that you have. If you use debt to source all these funds, you need to manage the debt portfolio. Now, again, financial risk, and that is what this whole concept or this whole session of the videos will be about, is how to manage what we call the foreign exchange rate. So when the exchange rates are going up and down, so what do you do as a firm to position yourself so that you will not be affected that much? Not only that, interest rates. If you remember the early part of our lecture, the beginning session, where I introduced financial management to you, we had monetary policy rates, we have fiscal ones, so tax issues. All right. So again, commodity prices. How are you going to manage things? All right. So these are critical functions of the treasury. Of course, it is there that the finance manager also functions. We also have investment management. So if there is money, there is a surplus cash, what do you do with it? How are you going to invest it? What kind of investment policies do you have? You remember investment appraiser, the steps: identification, selection. All right. So you do evaluation of them with investment appraiser. You select it. All right. When you select it, what do? You implement the project, you monitor the project. So what policies are you setting in between these functions or these steps to make sure that you are able to carry out proper investment policy? So we have investment management is also part. Then we have bank relationship management. Of course, you have to have every finance department deals with bank one way or the other. And so what you're going to do is that you need to manage such a relationship. So banking relationship, select your bank, do your negotiation with your bank. Of course, you'll be taking loans with the bank credit facility. You'll be buying probably exchange foreign currency. All right. Maybe dollar, maybe pound, naira, CD. All right. You need to have that kind of relationship. So here we talk about bank relationship management. We've already talked about the financial strategy, all right, because in the early part of our classes, we learned that financial planning is part of the role. So now, financial strategy, you need to make sure that you are always being in a position where you're able to achieve the goals of an entity. So this is more of some things that we do in corporate business reporting or case study analysis. So that is that. Of course, you need to learn how to do budgeting, okay, because you are going to budget. That is a strategic decision. Compliance and reporting, also, yes, you ensure. And these days, the banks are into that a lot, especially the treasury functions of bank. You've heard in Ghana, the policy that really runs that you have to tell us the source of your dollar income. Come with a receipt before the bank will accept your dollar into their account. So these are the things that you see, and we will learn some of the things that the Bank of Ghana is doing because of all these exchange rate movement. All right, so that is that. And so you may have a multinational, the international treasury functions also happen to them. They set transfer prices to reduce overall tax issues. I mean, they decide currency exposures that the entity must be, the level of risk of currency exposure an entity is supposed to be allowed, to either be allowed to fall under. So how much risk are you willing to bear in terms of exchange loss? So that is that. They help distribute cash across. So let's say I have an entity which is based in America and maybe exchange rate is eating up funds. They can distribute funds in terms of investment or putting money into capitals. All right. So that is that. We have devising investment strategies, short terms, and sometimes even long term, and netting currencies obligation. We will look at the netting currency obligation as part of the internal methods of managing transaction risk. All right. So the issue is that if I have a treasury function or have a treasury department, and let's say I'm in a multinational, all right, because we are looking at the international stage. Now, should I centralize my treasury department or I should decentralize it? What we mean is that should we let everything be at the head office or we should let everything be at the local? Because if centralize, you realize that you'll be having experts. I mean, all the experts are in people's head offices, right? And those who are the local and who are doing well such that they will be transferred to the head office. Yeah, you will have experts. That is it. And negotiations become easier because you can do bulk negotiations. Take it as if you want to buy dollar. I mean, if you want to buy some dollar with the treasury with the bank, looking at your branch company and its size, and looking at the size when it comes from the head office, what do you see? All right, so there are so many of them. Let me run you by. Okay, so you have efficiency and cost savings. All right. How does this come? Because you have economies of scale. Head office is that big. All right. I mean, they consolidate all their cash of the entities, and everything is so huge that they can make some kind of discount on negotiations. All right. So that is that. At the head office, you know that things are well under control because if it is done at the branch, people have to descend down to even come and do internal audits. All right. So you see enhanced visibility and control also there. Of course, you can optimize cash management. It's more efficient uh, doing something when there is a pool system than when it is separated as individual. I mean, it said united we stand strong, right? So that is it. Risk management. I mean, when you look at the central aspect, you will see that there is a more comprehensive and a coordinated approach to identifying and mitigating all forms of risk, either finance risk, which includes the foreign exchange. Okay. So those are the things: consistent policy, procedures, access to specialized expertise. That's true. The head office is where we make strategic business decisions. All those things are there. Standardized technology infrastructure. All right. So that is there. It is assumed that head office has it all. You can also improve your negotiations, where I refer to as the bulk negotiation and compliance too. But the thing about uh, decentralization is that there is no bureaucracy. Everything is moved. Decentralization also are closer to their market, so they have that kind of knowledge and expertise with related to their market. Local is very adaptable. I mean, changes can be made quickly. It's flexible, all right, and also employees are empowered because they are doing something. I mean, the morale that comes to your job satisfaction, you achieve something. When everything is at the head office, you are just sitting to transfer issues to the head office. All right. So when the thing is closer, there is quicker problem resolution. It promotes innovations and also creativity and reduces the management burdens, head office burdens. I mean, they are closer to the lower market, they improve entrepreneurship. So these are things that you can take a look at, all right? Great things or points that you can take a look at, all right, so that you will get a general overview of this. Now, let's come to the main issue. We are trying to deal with risk management. That is the main theme for this class, risk management. So under risk management, all we are trying to do is to find out how we can do the risk and return combination, given an entity's risk appetite. So basically, that is that. When we talk of a return, we've dealt with that, how much you are receiving from your investment. But like I said, to everything, there is a risk. The higher your risk, the higher your return. That is that. Even your learning is a risk. There are so many other things that you could use your time for, but you choose to watch this video. I mean, that's the risk. You are losing something. But if you stick to it, you get your return of passing your exam. So there is always something to lose. Okay. So you now need to identify and measure and sometimes transfer the risk. All right. It doesn't mean you are letting somebody do the exam for you, but you are letting somebody understand the concept and briefing you about what it means. So, like I'm doing for you. So that is that. So in terms of dealing with risk, many people have devised some strategies to deal with them. First of all, we have the risk mitigation. What is risk mitigation? Here, you are using policies, procedures. You are using rules to help reduce the risk or even prevent it if you can. So risk mitigation is the process where an entity reduces its risk exposure using policies, procedures. In general, we call them internal controls. All right. You are using controls to actually mitigate the risk. So these controls will help you to detect, we have detection risk. It will help you to detect them if you are not able to prevent them. Then it will help you to correct them. These are things you do in audit. So basically, you are using policies, procedures to handle risk. But there is another way of handling risk, which we call hedging. Hedging. So what does hedging mean? Hedging means taking an action today to predict an outcome of tomorrow. So you are taking an action today. And that action will predict the outcome of the future. So let's say we are in today and exchange rate in Ghana here is 16.2 cedis is to $1. And if you look at the way things are going, you foresee that it is going to go somewhere like 18 cedis is to $1. So if you are a trader who will be paying dollar to someone, what do you need to do? If you know that it is going to increase, there are so many things that you can do. All right. You can say, I'm hedging. I'm agreeing with the bank to buy dollar in the future time at, let's say, 17 cedis is to $1. So far as you agree, it doesn't matter the movement, you will still be doing it at the agreed rate. All right. You'll still be doing it at the agreed rate. That is what we call a forward. And we will look at all these things. So you are taking an action today so that you can determine the outcome of your future. And everybody is meant to hedge his life. Take an action today. All right. Then the last one is diversification. Diversification is just doing a conglomerate investment. What do we mean by that? We say this is where we apply the principle of do not put all your eggs in one basket. So do differing investment portfolios. Don't do one. So if you want to invest your money, don't put all in the financial institution. Buy a car for somebody to use as a taxi or Uber. Do farming. Why? Because in every industry, remember when we were doing work, there is systematic risk. And the systematic risk, you can't avoid it. Every company suffers systematic risk. So don't allow systematic risk to crash all your investment. Like the way here in Ghana, some people put all their monies in government bond. And one day we were just sitting there and they decided to do a discounting on people's bond. And what happened now then is that you are going to lose money. Imagine all your money were in the financial institution, then you are fully affected. But if you divest, by now, somewhere is making it for you. So that is basically the strategies to risk. Okay, so basically that is that. All right, so you can do product diversification or geographical diversification, whichever one that you would want to do. Basically that is that. Then you carry it along. Okay, so now the next thing we want to do is to now look at foreign currency risk management. Foreign currency risk management. There is a problem about foreign currency. Let me introduce it to you, because in the next video, we are going to look at how you practically do the risk management, how you practically do it. But let's look at foreign currency risk, because that is the first thing. Then we will also later look at interest rates, currency. This is the risk that if you do a transaction today at one specific exchange rate, it will change in future. And when it changes in future, it may go against you. So for example, you bought something when the dollar rate is 16. 16 cedis is to $1. But at the time you are going to pay, then it is like 18 cedis to $1. Then it means that you are going to spend more cedis on the same transaction. I mean, it doesn't make sense, but you are losing. These are the risks that you are likely to face. Now, in terms of exchange rates, each and every country has a way he deals with it. Yeah, each and every currency has the way it deals with it. So we will look at the way systems manage their exchange rate, because we have the floating system, we have the fixed system. All right, we actually have three. So, but let's look at these ones. In a floating system, the exchange rate is determined by demand and supply. And so, like you go to black market, it's demand and supply. Especially in our country, Ghana, the Bank of Ghana is now devising means to handle this. Other than that, it was just a mere demand and supply. So anytime the demand is outweighing the supply, then it means that the exchange rates are going to go up. All right. It is said that all the dollars are with the Baba in the black market. Yeah. So all the dollars are there. So you don't have dollars at the bank. And so therefore, when you are going to buy at the bank, it's very, very expensive. And the Baba will get to know it's very expensive to push his price also. So that is how it goes. And those who are in foreign trade are those who are really suffering on that. And even those of us who are not in foreign trade, the thing comes from the foreign land and we suffer on prices. We pray this change with the mechanism. All right. Now, if you are receiving, it can go against you. If you are paying, it can go against you. Depending on where you stand, the whole thing can go against you. And that is what this formula is about. Like when I said you were paying, because if you are receiving, then it means you are going to receive more cedis. So basically, that is that. So that kind of suffering that you go through with the fluctuations of the currency, the unfavorable movement of the exchange rate, is what we call currency blues. All right. So if a currency appreciates, then it means that the company will have to kind of, let's say if the dollar appreciates, it means the company needs more cedi. That's how you have to see it. If the dollar appreciates, it means you will need more cedi to be able to buy a dollar. So that is that. The current system that we have here are the dollar, the Japan yen, British pounds, and euro. And these days there's BRICS. These days the BRICS have come in. The Brazil, Russia, I think it's in Indonesia, the South Africa, they have come together and they are also forming a currency. Like the way Africa and ECOWAS has taken long time to bring up the ECO. There are already these ones that are spent. If you go If you go to US is not just one country. The United States, Japan, also the same. If you go to Britain is a combination of countries. They've come together to form their pound. All right. Then Euro is also the same thing, combination. So when is the combination of ECOWAS going to work? Or the African Union, when is it going to work? So there are countries where you realize that there is a fixed rate, and that one, the rate to exchange a currency is determined by the central bank. So for example, central bank can now set that every exchange of currency, let's say CD and dollar, should be done at 10 CDs is to $1. Yes, and everybody is supposed to abide by it. It's just that it is very difficult to do this, given that there is also revaluation or appreciation or devaluation of a currency. That is it. And inflation. All right. I've already talked about the floating. So the floating, we normally call it the clean float. But we also have the managed floating, and that is what we do in Ghana. So at some point, you see the Bank of Ghana coming to regulate, all right? We call it a dirty float, okay? And at some times, it is just left open like that. So that is that, the hybrid of the two. Good. So this brings us to the types of the currency, foreign currency risk. And here, this is where we are gradually gearing into the main business. All right. So what is the types of foreign currency risk? We have transaction risk, and that is what we've been explaining so far. The fact that you do a transaction at one point in time, and then by the time you realize the exchange rate has changed, so that you gain or lose on your transaction. All right. So that is that. And that is minimized usually by hedging. Yes, you do hedging. You take an action today for that. Then we have translation risk, and I think this is easy now because by far you have done something we call consolidation. And in doing that, you need to translate your overseas subsidiaries currency into your home currency. And each time you are doing that, you realize that there will be some kind of translation. Sometimes you get a translation reserve that is good. Other times too, you may lose on your asset. So that is that. That is that. It is an accounting risk. It is not a cash flow risk because you are translating the figures, and the figures are just figures on paper. Yeah. So when you are translating, maybe at the time you bought the asset, you bought a PPE, you bought it, let's say, when the exchange rate was 15 is to $1. And let's say you bought this thing, you bought it at $1,000. It means that converting it into CD, you will have 15,000 CDs. But let's say at the time you are translating them, all right, you are translating the figure, you are doing consolidation. So a foreign subsidiary own, you have to translate it. Let's say at the time you are translating it again, the exchange rate has fallen or the exchange rate has gone up, depending on the position you sit. All right. So let's say that you are preparing it in CDs. And so at the time you are doing your year-end financials, the exchange rate is good in Ghana perspective. It's 10 is to $1, meaning that that same asset you bought at $1,000, which was 15 in your books, is now going to be 10,000 in your books. So you realize that there's a translation risk just because you are translating the figures. All right, so that is that. Then the last one, so if you want to do this one, you have to hedge by matching. I'll show you how you do matching. The variation also in the value of your business because of the present value due to unexpected exchange rate movement. Now, you realize that anytime you are doing NPV, what do? You do the cash flows, you do your discount factor, then you get your PV, right? And if you remember when you were doing the IRR, if you pick a rate and the rate increases, the cost of the rate increases, what you normally see is that your NPV start turning into negative. Yeah. So as these things change, the present value of your cash flows reduces as the discount factor increases. The present value of your cash flow reduces. So basically that is that. And these discount factors are sometimes influenced by the exchange rate. All right, because exchange rate influences inflation rate. It does. But we will distinct them and talk about them very soon. So if you want to save yourself from this kind of economic risk, then it means you need to do diversification. All right, so that is that. Okay, so now as we are growing, there are some terminologies you need to know. Terminologies like what do we call it? Terminologies like exchange rate. You know the rate at which you can trade one currency for the other is exchange rate. The spot rate is the exchange rate at the date of transaction. The day you are doing a transaction, the exchange rate available is the spot rate. And the spot market is where you can do your spot rate. So where you can sell or when you can buy currency. So let's say a forex bureau or something, or a bank, or yes, illegally a black market. Then we have a forward rate. So a forward rate, I've already explained to you that you set a currency for an exchange. So if you are going to do a transaction in future, you go to a bank and you agree a fixed rate. So when you agree the rate, it doesn't matter how the reality will be, you always go by the agreement. So if we are sitting in today, and let's say the exchange rate is, let's say, 16.2 cedis is to $1. So we write it like the 16.2 is to $1. And if you want to do a transaction in future, let's say tomorrow or in a month's time, and you go and do a forward, you agree that in that 3 months' time, you will do it at 17 is to $1. So if that future time comes and the dollar rate is 18 is to $1, you still be trading at this. If it is 16 is to $1, you will still be trading at this. So as far as forward is concerned, the spot rates are irrelevant. You will use the agreed one. All right, so that is that. And where you can do that is a forward market. Then we have a direct quotation of a currency. So these ones that I've done, I am a Ghanaian. So how much of my home currency is equal to one foreign currency is what we call a direct. So that is that. So how much of my home currency is equal to one of the foreign currency? And that is a direct. But how much of a foreign currency is equal to one of my home currency is called indirect. All right. And when you go to the bank or a forex bureau, you see on their board two prices, like something like so you go there and you see that you see 14.6120, and always is quoted in 4 decimal places. All right, take note of that. And you have is to 16.2000. What does it mean? It means that this is the bank's bid price and this is the bank's offer price. So, or the bank's buying price and the bank's selling price. We also call offer price and ask price. Now, what does it mean? It means then when you go to the bank, say, and this is cedis. If you go to the bank, say you want to buy $1, you are buying $1, which means the bank is selling to you. And so you need to get the distinction right. Please always look at it from the perspective of the bank. Always look at it from the bank's perspective. this statement that I've made is very, very important. Very, very important. Always look at it from the bank's perspective. So if you are buying, then the bank is what? Selling. If you are selling, then the bank is buying. So this one means that they are trading in dollars, but these are the currencies, but they are trading for you dollars, because you see at the end is to $1, but we don't write. All right. So you'll do /$, which means that if you are going to buy $1, the bank is going to sell to you, and they will sell to you at 16. If you are going to buy, they will, if you are going there to sell, they will be buying. And you see, the bank always buy currency low and sells it high. Please take note of that. They are not a philanthropical institution. They make money. So the bank will buy from you low and sell to you high. That is how it is. All right, take note of that. It's a very important principle. As we are going on, you will be needing. So please take a very important note of that. Very, very important note of that. Then we have the concept of the spread. All right. A spread is actually the difference between this price and this price, the offer price and the bid price. All right. So that is that. So a spread may be given to you. So if I say that, as you can see here, so if you have this currency with plus or minus 0.0005, like I said, it's quoted in 4 decimal places, then it means that you can minus the 4.005 from here. All right. And you can also add it to this same 0.35. So you minus it and get this, and you also add it. So plus and minus, you do it on them. All right. And you can also get discounts and premium. Anytime you get a discount and premium, first convert those things into basis points. So make it 4 decimal places. Then the principle here is that add the discount and subtract the premium. All right. So please always check that. So if you have this discount, as you can see, this figure like this, you have to convert it into 4 decimal places. If you have this, you have to also convert it into 4 decimal places. Now, why is exchange rate moving? Why does it go up and why does it come down? Main reason one is because of demand and supply. Such that when supply exceeds demand, there is this kind of reduction in the exchange rate. But if demand exceeds supply, then you are going to see a huge rise of the exchange rate. So basically, that is that. So demand and supply is one of the causative of the exchange rate movement. Not only that, we want to also discuss this concept of purchasing power parity and interest rate parity. What does the purchasing power parity say? Purchasing power parity is just saying that at equilibrium, there is a law of one price. And it attributes the fact that exchange rates depends on inflation, all right, with the respective countries. So per what it suggests is that you look at these scenarios, these two scenarios. You are buying an item that costs 3,000 Ghana cedis in Ghana. And as at the time you are doing that, the exchange rate is 1.5. This one, you do, and please, let me advise that you do a simple if more or less divide analysis. So if you have 3,000 Ghana cedis and the exchange rate is 1.5, is to 1 pound, okay? So just do, if 1.5 is equal to 1 pound, then how much would 3,000 be? Please take the pain and do these things. Don't assume that you are always dividing. And don't assume that you are always multiplying. It's dangerous. Very, very dangerous. Okay. So what you are going to do is that you need to cross multiply. Here you don't know. So it's 1.5x is equal to 3,000. And therefore you divide. Because at a point in time, you may be multiplying. So please just take the pain and do that. Okay. And so when you do that, you see, as at the time you are buying this, the exchange rate is 1.5, and this is your figure. Because you are doing this thing as if you are in UK, and as you can see, UK currency is stronger. All right. So that is that. But in exams, we can make it Ghana currency being stronger. So don't keep to that assumption. Okay. So that is that. And given the estimated inflation rate, you see, if this one inflates by 5% and this one inflates by 5%, 3%, you will have to rework the exchange rate again. So now let's see what will be the exchange rate, and that is what you see here. So when you do the 3150 and this, you see that the exchange rate, the ratio has changed and it has increased, and it is because of the inflation that is happening. Because in Ghana, the inflation rate is very huge, 5% as compared. So it says that the spot rate or the exchange rate you will have at the end of the year or the future will increase or decrease depending on how inflation is occurring in the various countries. So it attributes it to the inflation. And so it makes a very simple argument that so purchasing power parity says that if I want the future rate, I can obtain the future rate by taking the spot rate today and making it a function of 1 over H and 1 over, so 1 is C, 1 is B. So if we make this one C, and it depends on your interpretation that you have with that. All right. Then it means that which one is HC? HC is the inflation rate of the in the other currency, other country, and inflation rate in the country where the currency is quoted, the spot is quoted. We call it the base currency. All right. So that. Now, so if I say 1.5 is to 1 pound, see this is 1 pound. How will it be? How will I obtain the future? And I've given you the inflation rate in CD to that one was what? 5%. And this one is 3%. So how are you going to do it? Now, it means that my formula S1 will be determined by, we will have SO, which is 1.5, multiply by 1 plus. Now, and we have here 1 plus. Now, which one is the base and which one is the currency within which the spot is traded? So the currency or the country within which the spot is traded is the one that you, the one in front. So what we mean by this, the HC will be the one that is trading the spot. What do we mean by that? So this will be the HC and this will be, so this is the base, okay? Let me highlight that for you. That is the base. The currency that has the one in front is always your base currency. It's always your base currency. Take note of that. So in this one will become my base currency. So it will be 1.1 plus 0.03. That is it. And here will be 1 plus 0.05. Take note of that. All right. Take note of that. So here, what you're going to do is to work it out. So it means that it will be 1.5 multiplied by 1.05 over 1.03. So this is what you are going to do. And you need to pick up your calculators and punch them. My guess is that you should be getting this one. All right, you should be getting this one. So what you have done, like we did, is this multiplied by the inflation rate here. You get this, all right? And this multiplied by the inflation rate here, you get this. So your HB is the currency that has this one there, but it is most of the time not written. Your HC is the currency, this one, the one that has the figure in front there. So basically that is that, all right? So take note of that. So if I give you this one, for example, how is it going to be? So like this. So CD is here. So 1.72. We'll be multiplying 1 point, which inflation rate? The Ghana one. So over. So take note of that. So that is what you are going to do. All right. So bear in mind that the one that is at the top is the one that has the figures, and the one that is the downward is the one that has the one in front. Okay, so learn how to do it, and that you'll be fine. Of course, it has some limitations. Okay, because future inflations are only estimates. You can't know the inflation; you have to predict it. So take note of that. And we have the interest rate parity. So here, the interest rate parity is not attributing it to inflation. It is attributing it to interest rate. So the same concept, you'll be doing the same concept, but it is not attributed to inflation. It is attributed to interest rate. Because when interest rates are high in different countries, it's going to affect the future spot rate. So basically, that is that. So they want to do the same thing. But bear in mind, the one that is always at the top is the one that has the figure in front. The one that the trading is the opposite. I mean, if you're able to identify the top, the other one is your base. Your base is the one that has one base. I mean, is the reference to. Okay. So if I ask you how you are going to do this, how will you do it? Of course, you see the way this thing is quoted. SF is to 1. So it means the SF rate will come down, right? Rate will go up. So SF, inflation. So it will be 1.03 over 1.07 because this pound is the base, all right? The base referring to the 1. All right, so basically that is that. Let's check on it. All right, so that is it. So that's all you do. What about this? Just that this one you are doing it in 6 months. So don't forget the rate should be divided by 6/12, 6/12. But as to which one will go up and which one will go down with giving the inflation rate, you see this one, the way it is quoted, which one is the one attributed to? Is the CD. So it means this time round, the CD interest rate of 1.03 will be down. And the euro with these figures there will be 1.06. So that is what you do. Only that the rates here should be divided. So you see something like is it 3 division of 3 is 1.5. Division of this is 3. So you should see the top to be 1.03 or something. Yeah. So that is that. So basically, that is where you end up being. Okay. So that is that. So like you see, the 6 is at the top. Each division is the 1.3, the 1 here. So basically that is all right. But if you are doing it full year, that is it. Okay. So the international Fisher effect is saying that, okay, you are saying on one side, the thing is caused by interest rate. On the other side, it is caused by the inflation rate. And if you remember when we were doing NPV analysis, we used to have the international Fisher effect that says that 1 plus M is equal to what? 1 plus R multiplied by 1 plus I. You remember that? Yeah, so that is the international Fisher effect. So it is saying that if you get the real required rate of return and you adjust it with the inflation, you get the money rate. The same way we have the international Fisher effect drawing some kind of analysis here with them. Because at one side you are using inflation, at one side you are using interest rate, and so it means that it's together, it is equal. All right, so basically that is that. So if I take the current ones and do the division, and if I take the future ones and also do the division, I mean it's the same. Okay, so basically that is that. The expectance theory just opens up that the current forward rate that you have serves as an unbiased predictor of your future. Okay, so you can use what you have today to do the prediction for the future spot rate. So it justifies the use of the current spot rate. All right, and it creates the relationship as you can see here. All right, so ladies and gentlemen, we will now be looking at how to manage the foreign currency risk. practical ways to do that, and that will be in the next video, where I will discuss the internal hedging processes and the external hedging processes. So be with us and catch up. God bless you. Bye-bye. Before I go, anyway, do this. We have somebody purchasing $3,000 worth of plant. The exchange rate is 15 cedis is to $1. The inflation rate for CD is 5%. Inflation rate for the dollar is 2%. Let me get your answer. All right, you can type it in the response or the comment section. Let me get your answer in terms of the forward or the future rate. All right, see you. Let me see your answer in the comment box. Bye-bye.